In this series, I'm going to be tackling some of the most common questions about the infinite banking concept. I'm going to break down each and every one of these, not in a extremely long amount of time. We're going to take a look at each one and try to answer some of these questions to help give you the most informed aspects and layout for you to make the best decision possible. If it's my money, why am I paying interest? So this is another question that often comes up in that people will ask, well, why do I have to pay interest on my own money? Well, first and foremost, you're not paying interest on your own money. You're actually borrowing using the cash value in a whole life dividend paying whole life insurance policy as the collateral in a loan from the insurance company. So you're not actually borrowing your money. And why is this important? Well, it's important because the money that you've put into the contract is always growing. It's always going to be compounding, both at a guaranteed rate as well as with the dividends that get applied back into your policy over time. The other thing that so many people don't think about is that everything in life is financed. And Nelson does a great job at highlighting this in Becoming Your Own Banker. You either are paying interest to somebody else, whether that's through a bank or something like that for access to capital, or you're giving up the interest that that money could have earned if you did something else with it. So with the infinite banking concept, what we are doing is we are allowing for ongoing, uninterrupted compounding to take place with the money that's been placed into the contract. And then from there, we are able to borrow against that. Again, you'd have to pay interest if you had to borrow from anybody else. When a person is making those loan repayments to the insurance company to repay the policy loan, a lot of times people are thinking it's like any other type of payment and the money's gone forever. Well, here's the thing that has to be remembered. It's more so that you're replenishing your own capital. And had you just simply went out and bought the item in cash, all of that money would be gone. You would not have it any longer. In this scenario, anytime money goes into a contract, it is creating ongoing capital, both currently and then into the future, that is going to compound at a, as I mentioned before, at a guaranteed rate along with receiving dividends. When you make those repayments, you are simply repaying that capital or replenishing that cash value, and all the while it has still been growing. So there's a difference between simply repaying a loan in which the money's gone and out of your hands forever versus repaying on a policy loan when that capital becomes immediately available to you again, typically within 5 to 10 business days, depending upon your company. The other thing to think about is who's benefiting when you today are making repayments on loans, you or the bank. Chances are it's simply the bank. And in this case, because you are the bank, because we're using a mutual company, you are part owner of that company. So as that company becomes more profitable, it actually continues to help you in the form of dividends. Those interest payments that are a portion of that repayment process, those actually benefit the company. Therefore, they're benefiting you in an indirect manner. Now, I get it. This is one that it takes people a long time to really come to grasp with. And I even did myself for a while. But once it clicks and once you start to see that this is about control and not about rates and not about interest, but more so I'm replenishing my capital system, it begins to shift our level of thinking. And that's something that's necessary. So it's important to think differently. And that's what I would challenge you to do in this situation.